Hey guys, Martin here from Financial Group. Just wanted to do a quick update to you about where the markets are at in the last week, the coronavirus, what's happening in the world. You have to be living under a rock to have not noticed that the markets are taking a bit of a tumble with this news. Now, I'm fortunate in the way that I work with clients, and you'll be aware that we're not jumping around and moving things. So my phone hasn't been ringing off the hook wondering about what we should do with the markets, and I think the way I set up structures makes it really well, but doesn't mean we're not watching things and keeping an eye on stuff behind the scenes. So I wanted to give you an update on a few things and also put some of this stuff into perspective. As we know, the news likes to sell bad news. Bad news sells billions of dollars wiped off the market. They're getting a lot of clicks or reads, whereas when the market does well, no one really talks about it. So, a couple of key things I wanted to highlight and touch on, I suppose, are the following. At the moment, it's still new. The impact on the coronavirus still isn't really sure at this point in time, either from a health perspective as well as from a financial world perspective. So some of this stuff still is a bit unclear, but it's not the first time we've been here. We've had other stuff over the years that's similar, but still every event has to be treated with respect to itself, but also put in perspective of where things are at. So at the moment, and all this stuff's happened really in the last week in the markets, is it's purely just emotional. People are scared of the unknown and therefore going to safety. And they think that taking money out of the markets is a safe thing to do. When I'm talking about that, I'm talking about like a very small percentage, but that makes the market go down, because if no one there's buying it, the market falls for a period of time. There's no fundamental news that's really come out that's changed about the profits of these companies or anything like that. At this point, it's all just emotional trading and not actually anything based on fundamentals. That won't play out for a little bit while. But also, I think it needs to be put in perspective in terms of where we've come from. And what I mean by that is that, yeah, the market's down, but I've got a chart here, which I'll link in the actual article. It might be a bit hard to see, but the market is down from a point of about 7,200 down to about 6,400 in the last 5 days or thereabouts. Now that is a drop, but this is the last 12 months. And what you can actually see is we're actually just back to a point where we were about 4, 5, 6 months ago. So it's not as if it's wiped off 5 years of returns or anything like that. It's really just had a really good run. It's come back to that point. It's still up from where it was a year ago. The market is up. It was at 6,120 at the low point in the last year. It's now at 6,440. So it's actually up 5% in that 12-month period, even with this big drop, plus dividends on top. So if you're in the market in the last 12 months, you've actually made about 10%. Now, again, we compare that to cash, which we might be getting 1% on. It's still an attractive return. So it's still the place to be from that perspective, even factoring in this loss in those numbers. If we go back even further, again, this is hard to read. This is a big drop, but again, it just takes us back to over 6 months ago. It wasn't that long ago that the market was down at below 5,000. So the fact it's now at 6,400 is actually the really strong gain in that 8-month period. If we go back even further, this is the last 5 years. Back here at a low point, the market was down to 4,700. So it's now at 6,400. So that's a massive gain over that period of time. It's a 35% gain plus dividends along the way. So you say 35% over 5 years, it's about a 7% growth plus the dividends. It's equally a 10, 11, 12% return over that 5 years, even with this drop. So even if the drop just stays, you've been in the market, you're still way ahead of where you were. So again, it's that perspective bit that, yes, my portfolio might be worth less than what it was a few weeks ago or a month ago, but it's still worth a hell of a lot more than it was a year ago, 2 years ago, 5 years ago. And also importantly, where it's going to be in a year's time, 2 years' time, 5 years' time, that kind of thing. So I'll click those the images, and you can have a bit of a closer look at that. A message that you've probably heard, and I always say basically, is people only lose money in the market if one or two things happen. They choose to sell or they have to sell. Now we put in strategies and portfolios for clients to take away the have to sell bit. If you're in pension or super, I would have spoken to you about the bucket approach. And the reason why we have those buffer accounts set up is exactly for the things like this. The market doesn't always float up, but the people who lose money are the ones that sell out because they have to sell out to go and buy that asset or pay their pension or do something with that money. I'm confident I don't have any clients in the market that have to sell at this point in time, because that's the way we set things up. So if we take away that option off the table, it's really only the choose to sell. And that's just about having the confidence and the systems and the structure to set up to make sure we don't choose to sell this time in the market. And if that's somewhere you're at, pick up the phone, give me a call, because we need to have a chat. I don't think that's the case, and I haven't had those calls so far. But a couple of images to kind of just further cement that, and some of these are a bit cheeky. It's just the sentiment about people, how not to deal with the share market. I want to sell when it's down because I'm a little bit scared, but I'll wait till the market evens out and things have been under control. Well, by that time, it's higher than it is. Often I see too many people selling at the bottom and buying at the top, i.e. they just sell when things are bad and buy when things are good and lose money that way. That's not how we want to set up portfolios. If you've got money in the market, it's there for the long term. And again, what are our options? We're going to go to cash and earn 1%. That's not where we want to be. So we need to be able to ride that out and have the confidence that you're in a position to ride that out. And that's the way to do that. Importantly, this actually isn't the first time we've been through this. Over the last 10 or so years, there's been swine flus, SARS, measles, dengue fever, Ebola, all that kind of stuff. And this chart is even smaller, so it's hard to see, but yes, we had drops over this period of times between 5 and 15%, something like that. But when they go away, etc., the market always bounces back because the fundamentals aren't there. It is just down to emotional selling. So if we don't take money out, we're not going to lose. The way we set that up is the bucket portfolio. We've got the growth part there. We've got the cash here. We've got the buffer to make sure you don't have to sell through that. So that should give you a lot of confidence that the portfolio is set up the right way, so that it might show that your portfolio balance is down, but in effect you haven't lost any money because the number of shares you own are still the same. If CBA share price goes from $80 to 75, your portfolio might look like it's gone down, but if you owned 100 CBA shares, you still own 100 CBA shares. Therefore, your dividend you get will still come through. When the share price goes back up, your portfolio will go back up. So we set up the structure so that when these things happen, we're comfortable. We can only control what we can control. We can't control what the markets are doing, but we can control in terms of how we set up your portfolio. And I've got confidence we're doing that the right way. That was the main thing I really wanted to touch on. It's emotional selling. In perspective, it's not that crazy. Yes, it's been a pullback, and yes, it's big, and billions of dollars wiped off, but in perspective, it's just back to where we were not that long ago. And importantly, if we don't sell out, we're not going to lose. When this flow's over and the market starts to return, we want to make sure your money's still in the market. If anything, and there are some clients that might be in the position where this is a buying opportunity. I still think it's a bit new, and in perspective, again, the market's not super cheap. It's not like the GFC when it was down 30 or 40%. It's down 10%, but the market's up 10% over the last 6 months. So just back to where we were. And importantly, we have that structure set up with the bucket approach, with the systems, with that longevity, that it won't affect you other than the value on the piece of paper. So if you've got any concerns, pick up the phone, give me a call. Hopefully it's been helpful, and catch up soon.